The MSCI World is one of the most famous stock indices in the world, representing 85% of the world's public market. Many top fund managers measure their performance versus the MSCI World, and is a popular choice for regular investors like yourself. But what is the MSCI World anyway, and does it actually make sense to invest in it? By the end of this video, you'll know all you need to about this index and why it's worth $99.5 trillion. Let's dive in. The MSCI World is a stock index that tracks the performance of 23 industrialized countries. The company, MSCI, is the publisher of various indices, just as, for example, the S&P 500 Index Committee is the publisher of the S&P 500 Index. MSCI stands for Morgan Stanley Capital International and was first launched by the large investment bank Morgan Stanley. The MSCI World is the most famous index from MSCI. However, unlike the name suggests, the MSCI World does not represent the entire global economy. It is limited to 23 industrialized countries and leaves out emerging markets and frontier markets, otherwise known as third world countries. MSCI maps out these countries in separate indices. Another reason why the name World is not entirely accurate is that it invests exclusively in large and mid-cap companies and leaves out small-cap and micro-cap companies. Large-cap companies are very large companies, also known as blue chips, such as Apple, Amazon, Microsoft, Tesla, Toyota, or Nestle. The abbreviation CAP in large, mid, and small cap stands for capitalization or market capitalization. The classification into these three categories is therefore based on the market capitalization of the company, so the value that the company has on the stock market. Small caps are not represented in the MSCI World. Despite these limitations that it does not invest in small caps and is limited to 23 countries, the MSCI World represents roughly 85% of the market capitalization in each country. This is probably one reason why it is so popular with investors. What's also popular, and a great idea by the way, is hitting the like button and subscribing for more videos. Let's take a look at which countries the MSCI World invests in and the criteria it uses to select them. Which countries and the percentage in which they are included in the index depends on the market capitalization of the country. The market capitalization of a country is nothing more than the sum of all market capitalizations of the companies listed on the stock exchange in that country. The market capitalization of Germany, for example, would be the total market capital of all companies that are in the DAX, all companies that are in the MDAX, in the SDAX, in the TechDAX, plus all companies that are listed on the stock exchange but are not represented in an index. The same goes for any other country. It pretty much adds together all the companies that are publicly traded for that country. The higher the market capitalization, the higher the percentage in which they are represented in the MSCI World. By far, the most strongly represented country is the USA with over 73%. This means that 73% of the market capitalization of the MSCI World is made up of US companies. The next largest country with 5% is Japan, followed by the UK, Canada, and France. However, these country weightings in the index are not set in stone. They change depending on the development of the individual stock markets in the individual countries. If the stock market of one country has developed better than the stock market in other countries, the market capitalization of that country increases. As market capitalization increases, so does the weight that the individual country has in the MSCI World Index. Let's talk about the strong weighting of the USA. The reason that the USA is so heavily weighted is not because MSCI is an American institution, but because America has the largest market capitalization by far ahead of all other economies in the world. However, this does not mean that the capital invested in the MSCI World is invested exclusively in America. America has most of the globally active companies such as Facebook, Apple, or Google, whose products are used worldwide. Now that we know which countries are represented in the MSCI World, let's take a look at the criteria used to select these stocks. Here too, MSCI is largely based on market capitalization. The goal is to represent approximately 85% of a country's market capitalization. This means that the companies of a country are bought in order of size until 85% of the country's market capitalization is reached. Since this is the case for the 23 countries represented, there are approximately 1,600 companies represented in the MSCI World. As mentioned in the beginning, however, only large and mid-cap companies are invested in. Now, where does MSCI draw the lines between a large cap and a mid-cap? Here too, MSCI is again guided by market capitalization. The largest 70% are defined as large caps, the following 15% as mid caps, and the last 15% as small caps. Since the index only invests in large and mid-cap companies, we thus arrive at our 85% market capitalization of a country. So 70% plus 15%. Another factor besides market capitalization that plays a role in the selection of the individual stocks that are included in the index is liquidity. MSCI looks at how available a stock is on the market. If it is hardly traded at all, it will not be included in the index, as it will be difficult for funds or ETFs to track this index if they do not have the opportunity to freely buy and sell shares. Let's take a look at the largest companies in the MSCI World by market capitalization. At the current time of filming this video, Microsoft currently has the largest share with almost 5% of the total index volume. This is also understandable according to MSCI's logic, as Microsoft is currently the largest company in the world by market capitalization. Here, you can now see the complete list of the 10 largest companies in the MSCI World. As with the countries, the percentage distribution of these companies is not fixed and changes constantly. Let's now look at the 3 methods that can be used to measure the performance of the index. There is the performance method, the gross method, and the net method. The performance method takes into account only the price performance of the stocks included. Dividends are not taken into account here. This is different with the gross method. Here, the price performance is taken into account, but dividend payments are also added. According to the gross method, the performance is therefore always higher than according to the performance method. The net method takes both the price changes into account as well as dividends. However, withholding taxes that have to be paid in the individual countries are deducted from the dividends. The withholding tax on dividends in the US, for example, is 30% withholding tax. If a company distributes $100 in dividends, this $100 is fully taken into account in the calculation using the gross method. However, only 70% is calculated using the net method, as 30% withholding tax is withheld. The net method is therefore the method that is most representative for the investor. Different countries have slightly different withholding taxes for investors abroad. For example, in Germany, it's 25%, and even for the US is 30% tax, if your country where you and your investment account are based has a tax treaty with the relevant country where the company is based, this tax can often get reduced. Now that we know what the MSCI World is and how it works, the only question that remains is whether investing in the MSCI World is a good decision. So what the advantages and disadvantages might be. One of the biggest advantages of investing in the MSCI World for investors is that you avoid the so-called home bias. Home bias is a proven effect that shows that investors prefer to invest in stocks from their own country of origin. This makes them less diversified and good return opportunities could pass them by. In addition, the MSCI World with over 1,600 companies has very broad diversification, so the risk is spread out. If we look at the performance, we find that it is still subject to large fluctuations. In crisis years such as 2002 and 2008, we see that it also lost significant value. So, like any investment in equities or stocks, it will have fluctuations. What you have to keep in mind when investing in the MSCI World is that you are actually only investing in 23 industrialized countries and not, as the name suggests, in the entire global economy. To map the entire global economy, you would have to invest in other indices that map, for example, emerging markets or third world countries. Nevertheless, an investment in the MSCI World is a perfect start for passive investing. You can already start with a savings plan of even just $25 per month. I've already shown you how to get started in our Investing Basics playlist, the link you'll find above and in the description. And that's all there is to say about the MSCI World. If you like this video and want to end up investing in MSCI World ETFs or similar, then you might be interested to watch this video here on our 6 beginner ETF investing mistakes and how to avoid them. Thanks so much for watching, have a great day, and see you in the next video.